Hello, everyone. Good afternoon. Thank you so much for taking the time to join us today. Today, we are going to discuss MoneyGuard, but MoneyGuard a little different than we all know it. Today, I'm thrilled to have Rob Johnson from Lincoln Financial. He is our sales rep, and he is going to go through the new product, the opportunities that we're seeing, and also some sweet spots of sales. So, with that, Rob, you ready to take it away?
I'm ready. Thanks for the invite and for everyone carving out a little time this afternoon. We'll make this hopefully no longer than 20 minutes so you guys can get on with your day and hopefully get on the back half of the week here. So let's dive right in. So today we're going to talk about MoneyGuard Fixed Advantage. This replaces our flagship MoneyGuard 3 product in all states except for right now California, New York, New Jersey, and Montana. Available everywhere else. I don't see it coming to, well, it's not coming to New York. It won't be in California anytime soon, but I do anticipate New Jersey and Montana falling in line most likely next month. But we'll talk about that. We'll talk about kind of where it fits versus our competition, and then what makes us unique when it comes to that underwriting a new business process. Again, you could see the states for those of you that are working in Virgin Islands or Guam. I'm sorry, also not available there. So MoneyGuard, this is probably familiar to many of you. These asset-based solutions, for most of you, you think of it as a live, quit, die proposition, typically built on universal life, whole life, sometimes a variable universal life chassis. MoneyGuard Fixed Advantage, like most of its other competitors in this space, is built on a universal life chassis. This provides the guarantees that your clients are looking for. All premiums are guaranteed. All the values they see on the ledger are guaranteed. We cannot come back and ask for more premiums. And they know with Lincoln, and this is unique to Lincoln versus some of the other players in this space, is that there's going to be a death benefit if they never need long-term care, at least what they paid in. There are other options out there where the death benefit might be less than what they paid in. But with MoneyGuard, it can never be less. We can't even design a plan where the death benefit's less than what they paid in. But I always like to look at this as leverage legacy liquidity. The reason we're buying this is that piggy bank on the left, the biggest piggy bank. These are the tax-free LTC dollars. Typically out of the gate, you're going to see 3 to 5 times leverage day one on their dollars, and then we offer a 3 or 5% compound inflation. Most folks go with the 3% compound. Obviously, depending on their age, we get folks in their 50s, and then they'll typically do a 5% compound. But then the legacy bucket, again, guaranteed to be at least what we paid in. And then with Lincoln, this is our 34th year in this space, longer than anybody else. We wrote more asset-based business than any other carrier in this space last year. Of that business, 96% of that went to the ROP option. You'll see it on the screen, option 1, which is the 70% return premium. So if the client ever changes their mind, they get back 70% of what they paid in up until that point. Option 2 says it has a vesting schedule. We call this sometimes the vested ROP option on the screen here is option 2. You'll see it, the vesting schedule starts at 70% in year 1. After year 10, you can get back 100% of your premium. I'll tell you about 96% of the applications received last year went with option 1 because it provided the biggest pool of LTC benefits. And honestly, that's why folks are choosing this. No one's buying MoneyGuard to maximize a death benefit or for cash value. This isn't for a retirement income stream. This is to build a pool of dollars, of tax-free dollars, should they need extended care down the road. So how do the two compare? We'll look at a quick case study here. This is Susan. She's married. We give a couples discount as long as that individual is married, even if the spouse does not apply. To note here, we also don't have a tobacco rate. Unlike most life or long-term care policies that have a preferred non-tobacco, a preferred tobacco, a standard tobacco, we only have 2 rate classes, a couples rate and a standard rate. And you get the standard rate if you're single or widowed, regardless of tobacco status. So this is an example where Susan here elected to pay $10,000 a year for 10 years on a 6-year benefit period. Typically with a MoneyGuard, especially with Fixed Advantage, you're going to see a 5 or 6-year benefit period be the product sweet spot, typically with a 3% compound inflation. Again, sometimes with the younger ages, you'll see 5%. But let's look and see how they compare. You'll see this option 1 here on the first row. At age 85, someone that paid in $10,000 a year for 10 years would have a monthly benefit of $9,000, which annually is $109,000, obviously. And then, but by age 85, they have $705,000 of tax-free LTC benefits. You'll see that death benefit, again, never less than what they paid in. And then the 70%, $70,000 ROP. The monthly benefit with that vested ROP option is about $1,500 less. Pool of dollars, about a little over $115,000 less by age 85. Going to have a slightly higher death benefit, but you'll have the ROP after 10 years being equal to what they had paid in. Again, most folks, you know, for my money, if I'm meeting with an advisor and their clients, I say, what is the true reason we're doing this? Oh, it's to maximize LTC benefits, to provide tax-free dollars to allow my loved ones, hopefully, to supervise that care rather than be the ones to provide it. That's why most folks go with the basic or option 1 ROP. So what's changed for many of you? I mean, this is MoneyGuard is the maverick in the industry. It's what all the other carriers in this space compare their product against. So if you haven't looked at it since last year, in January, we did a pricing reduction anywhere between 9 and 17% on that 6-year benefit plan. Our issue ages are 40 to 80. Again, 3 and 5% compound. We talked about the 2 ROP options. Again, unique to Lincoln being the only asset-based LTC carrier that has a true 0-day elimination period for all services. And I like to look at that really as a not having a deductible. And where, you know, if you have a 90-day elimination period, that results in a true deductible. We'll talk about that. And then we'll talk about our streamlined underwriting process. That's the same, but we've enhanced that to give the clients a little more flexibility in how they answer those health questions and communicate those with us. So what else is new? We've added a brand new benefit transfer rider. This is unique to Lincoln. Even though MoneyGuard is an individual policy built on a UL chassis, which frankly allows couples to customize their policies, have different benefits, have different premiums. We can customize those, but benefit transfer rider allows us to transfer an unused, a portion or all of an unused death benefit to a surviving spouse and enhance their own benefits. And we'll dive into that. We've also updated our FlexCare Cash to provide more flexibility for informal care at home. So what is benefit transfer rider? Benefit transfer rider is a no-cost addition to MoneyGuard. It's automatically included. You don't even elect it on the application. It's included in all MoneyGuard Fixed Advantage policies. But upon the death of the first insured, we're now giving that beneficiary 3 options. Previously, that beneficiary, their only option was to take the death benefit. We know not all the time folks needed that death benefit. Now we're going to give them the option to either 1, take that full income tax-free death benefit, 2, use that death benefit. So if we're thinking about that surviving spouse, say he passes away, she would have the option to take that death benefit and purchase more benefits on her own MoneyGuard policy. Or 3, do a little of both. Maybe that surviving spouse would like to have some of that death benefit. Maybe, for example, they had a $100,000 death benefit. Maybe they'd like to take $30,000, use that to pay the funeral or other costs that they have, and then like to take the balance to purchase more benefits on their own policy. Here's the nice part. We're not asking them to decide what they want to do today. They decide at that own unique time. So let's look at a case study. So this is an individual that's 60. Our average MoneyGuard buyer last year was 59. So this is spot on. 6-year benefit period. This individual decided to do 100,000 single pay. Our payment durations are anywhere between 1 and 10 years. Anywhere 1, 2, 3, 4, up to 10 years. In this case study, we've illustrated that spouse passing away at age 70, just so you get some idea. You'll see here, benefit transfer funding amount. That's the amount that that surviving spouse decided, say, you know what, I have a $100,000 death benefit. I'm going to use that to enhance my own benefits. So you can see their surrender value went from 70,000, which we knew they had chosen the basic ROP option, to 140,000. Their death benefit, we're leveraging these dollars. So typically that death benefit for someone at that point, you know, eventually would have leveled out. We saw it in that case study before, around 100,000. Now their death benefit goes to 223,000. So we've leveraged those dollars on the death benefit. So it's not just a dollar for dollar increase. We took their LTC pool of dollars at age 69 to 410,000, all the way to 596,000. You can see by age 71, it's already up to 700 or 614,000. So in 2 years, this individual with no underwriting, keep in mind, no underwriting, they went from 410,000 at age 69 to having a pool of dollars of 614,000. Now their monthly benefit stays the same because this individual had a 3% compound inflation rider. But if we look at a comparison over here on the left-hand side, if they had elected to not utilize the benefit transfer rider, at age 85, they would have had a pool of dollar of $659,000. Again, tax-free, available for LTC. They had a 6-year benefit period. That was the sweet spot for them, and a death benefit of 100,000. Because this surviving spouse decided to take that utilized benefit transfer, now they have 929,000. So it took a $100,000 death benefit. They've increased it almost $300,000 in terms of total LTC benefit. They went from a 6-year benefit period, 72 months, to 98 months of duration and 213,000. So we're essentially allowing them to go from an individual policy to a second to die, but we're not asking them to decide today. They decide at that unique time. Here's what I like about it. This individual at age 70, you know, they decided to utilize benefit transfer rider. Because we're not doing underwriting, that surviving spouse or daughter or son, whoever the beneficiary is on the policy that has their own MoneyGuard policy, because we're not doing underwriting, that surviving spouse could be unhealthy. They might already be on claim. They might have Alzheimer's. They might be using a 4-prong walker. We're not asking about their health. We're allowing an unhealthy individual to enhance their own LTC benefits with no underwriting. And this does not have to just, we're not limiting this to spouses. If my mom bought a MoneyGuard Fixed Advantage policy, and then I, as her son, bought a MoneyGuard Fixed Advantage, say my brother did too. We're 50-50 beneficiaries. My mom passes away. My brother could elect to take his portion of the death benefit. I could elect to enhance my own policy using all or a portion of that death benefit. Our only rule is there needs to be at least $25,000 of death benefit remaining to enhance someone's own policy and utilize benefit transfer. So again, really unique. We're providing more flexibility for beneficiaries, and that when we're not doing underwriting, we're allowing them to decide at that time. You know, in this case study, they went from 659,000 to 929,000 in LTC benefits. Really unique. What else have we done? We've expanded our FlexCare Cash. So we rolled out FlexCare Cash really based on feedback that we heard from the field, from partners like Katie here at Premier, saying that, hey, we understand there's reimbursement policies, there are indemnity style policies, there's advantages to each. But we know there's situations where maybe a spouse or a loved one, maybe someone else living in the same house is providing that care. So before, when we rolled that out, we limited that cash benefit to 5 days a week, and it required that be in conjunction with other formal care. So maybe a home care agency came in a couple days a week or 1 day a week. We've eliminated that restriction. Now you could get cash up to 7 days a week, and that amount that's available to them is equal to half of their LTC daily benefit. So if you had a daily benefit, in fact, let's look at an example. This is a $9,000 monthly benefit. We know that equates to about $300 a day. So if the plan of care, which every LTC policy out there requires an arrangement for a plan of care. So if this plan of care said, you know what, my wife is going to take care of me 7 days a week, every day of the month. We don't need a home care agency yet. She's able to provide that care. And keep in mind, all the LTC policies, you still need to have been certified that you need help with 2 out of 6 ADLs. So that's no different. You still have that qualification. But in this case, where MoneyGuard used to not provide any benefits if an informal caregiver, now will provide up to $4,500 per month in this example on a $9,000 monthly benefit. Now, if that spouse provided 2 days of care during that week, in this example, we would pay them $300 for those 2 cares. The nice part about it is it's not an either or. So in that latest example where the spouse took care of them 2 days a week and we had a home care agency come in the other 5 days, you would still have the balance of that cash benefit to reimburse for qualified care. So it's not an either or. Our only rule is we're not going to pay an informal caregiver on the same day that we're reimbursing for formal care. As long as those are separate days, they can get a little from each bucket of money. So again, more flexibility than we've ever offered with MoneyGuard, and we're really excited about this and enhanced benefit. So where do we land? I mean, are we competitive? Are we in the ballgame? I mentioned our reprice back on January 10th. Each product's unique. We have great competitors. If we look at these 4, the list on the screen, these are the top 4 in asset-based LTC sales last year. What we did on this case study is we ran the maximum LTC plan design with each of these. So which plan design provided the highest monthly benefit for that individual? If you look at it, this is a male age 65 buying $100,000 or a $10,000 10 pay over 10 years. We did a 6-year 3%, again, kind of being that standard, and ran max LTC, which is, as we discussed earlier, the 70% ROP. We ran max LTC for Securian and Nationwide and One America. You're going to see we're right there. In fact, we're in this slot for males. We're number 1, provided the highest monthly benefit, the biggest pool of dollars. One America has a slightly higher death benefit than us, but you can see our death benefits at least equal to what we paid in. Will we win, quote unquote, win every single time? No, we're not going to win every single time, but we're going to be in the ball game. You can see here with Securian and Lincoln and Nationwide, we're right there with the monthly benefit, $5,048. The difference here, again, we talked about it and we'll talk about it here coming up, is that elimination period. We're providing that $5,048 at age 85 from day 1. So even though another carrier might have a slightly higher monthly benefit, you have a 90-day elimination period with them. So you are paying out of pocket the first 90 days. We also know is about 1 in 4 LTC claims is done by 90 days. So Lincoln will have paid out dollars before another carrier has paid out a penny. So again, not going to win every single time, but if you look at cumulative between the male and female total LTC benefits, if we combine those two, we would have paid out more dollars than anybody else, and from day 1. The other unique thing about Lincoln, again, we talked about it, is that elimination period. This one shows 90-day cost for assisted living. I frankly think that number is probably a little bit low in most areas, but we're assuming 90 days in assisted living is about $14,500. Assuming 30 years down the road at a 3% increase, that's about $25,000. So on a 90-day elimination period, actually we went out 20 years at 3% annual increase. That's about $25,000 out of pocket first before another carrier would pay out $1. Again, that's a big difference with Lincoln, where we've paid out those benefits before anybody else has paid out a penny. The last thing I want to touch on, and I know for a lot of you that are on this call, you may not do insurance all the time. You want a carrier that's easy to work with, that's simple. We've enhanced this process. In fact, we've been really the leader in how we underwrite this. When we rolled out MoneyGuard 34 years ago, we were doing the underwriting just like everybody else. Full-blown paramed, we ordered medical records, we might have done a phone interview. We have enough of a claims history over that 34 years where about 19 years ago, we moved to the streamlined underwriting process. What does that mean for your client? We really want to meet them on where they're at. So you can do a paper or an e-app, whatever you feel comfortable doing. For most of the last 15 years, we did this bottom portion, meant we jumped on the phone with the client and did a phone interview. That phone interview lasted 45 minutes to an hour and 15, depending on how in-depth their health history was. If they were 61 or older, a portion of that call would be a cognitive screen, which typically lasts about 15 minutes. What we've learned, and for those of you that have done any type of long-term care, it's easy for phone calls to go sideways. They might not like the interviewer. They might be nervous. They might not be prepared. They don't have when their doctor's visits were, when was the surgery, what medications. We've now introduced an option. I can only think of one other carrier in this asset-based LTC space that's doing this, is offering an online PHI. Online PHI has so many advantages. We'll send a link to your client to ask them to answer health questions. They can start and stop that at any time, where the phone call, you're in it till the end. With an online PHI, they can do it 24 hours a day. They can answer 10 questions, stop, come back 3 days later, finish it. They can review their answers. They can print a PDF of their answers, so they have it black and white how they answered. They can also elect to flip to a telephone interview if they get halfway through and then this would be easier if I just talk to someone. They can do that. They also, between 8 and 5 Central Time, they have the ability to chat with a Lincoln New Business representative if they have questions on one of the questions in the online PHI. The only thing we do, if they choose the online PHI, we do need to do a phone call, and each carrier does that cognitive screen at different ages. We do it for everyone 61 or older. And so after they've completed the online PHI, we'll call them to schedule the cognitive. That's just going to be a 15-minute cognitive screen. For my money, that's the way to go, because it's short and sweet, easy to remember things, less of a chance that your client might make jokes about memory loss. Far and away the best way to do that. Once we gather all of that information, whether they had a cognitive screen or they did a telephone or phone PHI, we typically, our goal is to make a decision within 5 days. Right now I get an email every morning. We're right at 3 days as far as making an underwriting decision once all those requirements are in. So as quick as your client can do that online PHI, especially if they're 60 or younger, if we send them that email today and they knock it out tonight, we'd typically have a decision for your client in current times by Friday or Monday. That is a huge advantage. And then we offer a variety of ways to do the policy delivery, whether it's a secure PDF, DocFast, or what most folks choose is a DocuSign e-policy delivery. And most folks are familiar with that if they've bought a house anytime in the last 5 to 10 years. So a variety of ways to make this easy. I'm right at just over the 20-minute mark. Appreciate your time today. And Katie, I want to turn it back to you.
Thanks so much, Rob. A couple questions have come in.
Yeah.
Number one would be regarding certifications, which I'm guessing they mean LTC certifications, along with, is there any specific product training in order to get set up to do this?
Yeah, there's no specific product training. They would still need to, depending on the state, and my friends at Premier have that guidelines, and I'll send it to you. For us, you need a life and health license, and then the LTC training, obviously the initial 8-hour training, and then the ongoing, in most states, 4-hour training every 2 years. But no specific product training, because this is just a fixed LTC product.
Perfect. Another question is regarding sweet spots.
Mm-hmm.
Age,
Sweet
I'm
spots,
guessing
far and
here,
away.
or and maybe underwriting.
Yeah, sweet spots for us as far as product design is typically going to be that 5 or 6 year benefit period with 3% inflation. I worked on an older client, a 74-year-old client yesterday. When we looked at all the options, that client was 3-year 5% compound inflation. So it really varies. What's nice in every illustration is we're going to show you, say you've told us how much premium is going to be used to fund that. We're going to show you a quick quote page, so you're going to see all the available plan designs. So you don't need to go back to Katie and her team and run multiple illustrations. You're going to see all of the available plan designs, what the benefit is today and benefit at age 85. As far as underwriting, obviously the key underwriting sweet spot is not having a tobacco rate class. Our guidelines, we think about the carriers like Nationwide and Securian and Lincoln, all really similar underwriting, because we're doing essentially the same underwriting process guidelines. There's not a specific condition I could think of where we're more lenient than others outside of the tobacco and the comorbids that go with that. But any other questions?
Another question is can someone request an actual physical policy?
Good question. I will find out for you. I don't think so. I think everything is, we'll send a PDF and it would need to be printed. But I don't think we're at a point right now still with the limited folks in-house at Lincoln where we're actually printing policies right now. But I'll verify for you, Katie.
Perfect. Well, Rob, I think we've addressed all the questions for now. As always, if anybody comes up with anything further that need additional details, feel free to give me a call here at Premier. And if I don't know the answer, I'm pretty positive that Rob would be happy to get on the phone with us and address anything that we couldn't hear. Yeah. With that, I want to thank everybody for the time. And Rob, as always, I appreciate it very much. Love seeing this new product and the process. So with that, everybody have a great afternoon, and I look forward to hearing from you.
Thank you.
Take care. Goodbye, guys.